So we just had a student that had a deal that could spin off more than $2.6 million. It's for 45 acres. It's just a piece of dirt. And the seller has a seven-figure price in their mind. Now, on paper, this deal looks incredible. But let's be honest, sellers' asking prices is usually based on hopes and dreams, not on dollars and cents. So before we can even think about making an offer, we do this. We run the numbers to find the truth because the truth is almost always hidden in those numbers. So in this video, I'm pulling back the curtain on that exact deal. You're about to see our exact step-by-step playbook for reverse engineering the numbers, cutting through the seller's rosy valuation, and landing on the only price that we could ever actually offer. Now, we were told that this 45-acre deal had the potential gross development value, or GDV, of $2.6 million. Again, the seller wanted a seven-figure check. Our job is to find out if there's any meat left on the bone after the brutal reality of development costs sinks in. This is the process that separates professional investors from gamblers, and it all starts not with a calculator, but with a satellite image. See, the first thing that we do doesn't start with calculations again. It starts with a free tool that anyone can use, Google Maps. Before we waste a single second on complicated math, we do a quick gut check. We pull the property up and we ask some dead simple questions. First, is there clear legal road access? If you can't drive to it, then the property may be basically worthless. And if not, how much development potential is there even there, because you're going to have to access the property. So we are looking for paved roads that physically touch the property line somewhere. Dirt roads, yes, that's okay as well, but they can be a huge red flag because they tend to scream infrastructure headaches ahead. Not always the case, but just something that we're looking at. Next, what's around? Do we actually see any neighborhoods? See, we want to see houses, not just miles of empty fields. Seeing existing developments in the area tells us that utilities like water and power are probably close by, and that's a massive win. And obviously, we're also seeing that people actually care about living there. We don't want to put a development in the middle of nowhere where nobody else is around, because who would be attracted to it? We're also scanning for obvious deal killers. Are we staring at a sheer cliff, a protected wetland, or some sort of swampland? Is there a giant highway that's slicing right through the middle of the property? See, this first 5-minute look is all about spotting these major roadblocks. And if it still looks good from that 30,000-foot view, then, and only then, do we move on to the most critical step. So this is the single most important rule in all of development underwriting. You must start with your exit. You need to know with confidence what the finished product will sell for before you can even begin to guess what the raw land is currently worth. See, we have to treat that $2.6 million gross payout claim as just a number until we prove it ourselves. So to do that, we jump on sites like Zillow and Redfin. But here's the pro tip here. We are not looking for comps for a 45-acre piece of property. That's a rookie mistake. See, we're looking for comps on what we're going to create, finished, buildable lots. So for this deal, the early idea was that we could carve out 44 one-acre lots. So we searched the immediate area for recently sold vacant one-acre lots. We're hunting for at least 3 to 5 solid comps, all within a mile or two, that have all sold within the last few months. So let's say that that similar one-acre lots in this micro market are consistently fetching around $60,000. Well, now we can do some simple math. If we can realistically get 44 lots and each sell for $60,000, that puts our potential gross revenue at $2.6 million. So hey, guess what? The seller number actually checked out. Again, at least on the surface. But this is exactly where amateurs stop and professionals get started. Remember, for a real offer, we'd never just trust online portals. We'd be verifying all of this with local brokers, digging through official county records to get the full story. And that $2.6 million number sure is exciting. It's big, it's flashy, but it's also just a vanity metric. Gross revenue is not profit. It's the starting line from which we begin subtracting all of the pain points. The real story of any land deal is written in the costs. All the things that have to happen between buying that patch of dirt and selling those finished lots. We're talking about the developer's costs, realtor commissions, closing costs, engineering, surveys, legal fees, and all of the monster expenses of putting in roads, water, and power. That $2.6 million has to absorb all of that. And if there's anything left over, that's what we can get paid. Okay, so earlier I said ditch the calculator. Well, now that we've gone this far and the numbers are still meshing somewhat, now it's time to pull out that calculator. And this is the real work happens. Our entire mission here is to work backwards from that $2.6 million in potential revenue to figure out what the land is truly worth to us as an investment. So first things, we have to pay ourselves, right? A developer's profit isn't just a hopeful leftover. It's actually a line item, just like concrete or lumber or anything on there. It's the payment for taking all of the risk. Now, there's no universal number, but on a project like this, a developer might aim for 15 to 20% profit on the gross value. So for $2.6 million project, a 15% target is nearly $400,000. So we'll subtract that right off the top. Next up is the selling costs. When we eventually sell those 44 lots, we'll be paying real estate commissions and closing costs. So a safe bet is to budget around 8% of the gross sale price. Again, on $2.6 million, that's another $200,000 plus that just vanished. Now for the big one, hard costs. This is the dirt moving, the pipe laying part, and where most deals go to die. We have to account for clearing and grading that land. The cost swings wildly with the terrain and trees, so a single average number is completely useless. For our first pass, we might pencil in something like $35,000 per acre. But you can absolutely need local quotes for a real deal. Then comes the road, the drainage, the utilities. Here is where the county calls out the shots. Do they want paved roads with curbs and gutters? Or is gravel okay? That difference alone can be hundreds of thousands, sometimes millions of dollars. We also have to model the cost to get power and water to all 44 individual lots. Then you have your soft costs, civil engineering, surveys, legal fees for subdividing, the permit fees. These are super specific to the local market. And in some places, permit and impact fees can be a few $1,000s per lot. In other areas, they can top $100,000. Soft costs could plausibly be anywhere from 5 to 15% of the total project, but we have to make an educated guess for our model. Finally, we have to put in a contingency fund. We always add a contingency of around 10% of our total estimated cost because something always goes wrong. An unexpected layer of rock, a surprise permit fee, a delay in approvals. It's going to happen, guaranteed, and you have to pay for it. I know it's a ton of moving parts, right? And it can feel overwhelming. Keeping track of everything is crucial so you don't miss a thing. And the framework that we're using here actually comes from one of our students, right? She used one of the advanced videos in our course to start evaluating this very deal. And stick around for a couple more minutes and I'll tell you more about that and what she did. But again, let's stress test all of our assumptions now. We built out our model, but the model is based on one giant assumption, that we can actually get 44 buildable lots. The final lot count is never a guarantee. It's dictated by the county rules on setbacks, road design, open space, and drainage, and it's dictated by the land itself. For example, a lot hinges on soil tests. If the lots need individual septic systems, every single one has to pass a percolation or perk test. A failed perk test here is a huge deal. Sometimes you can install a pricey alternative system or connect to a main sewer line, but it can also make a piece of land totally unbuildable, which completely torches the deal's economics. Because of all this uncertainty, we have to run different scenarios. What if we only got 40 lots instead of 44? What if we only get 35? See, we now have to plug these numbers into our calculations. See, a lower lot count doesn't just cut into our revenue. It means that all of those fixed costs for roads and engineering get spread now across even fewer lots, crushing the profit on each and every one of them. We also have to think about our exit strategy. The numbers that we ran assume we take the riskiest path, full developing the lot ourselves. Now, other options exist, like getting the project approved with entitlements and selling the paper lots to somebody that has a lot more pieces in place to actually go and develop them. So we're putting them to a builder or a developer. But that exit always comes with a steep discount because the next guy is now taking on all the construction risk and it has to make sense to them. Okay, so after we've worked backwards from that 2.6 million in potential revenue, and after we've subtracted our profit, selling costs, and the massive infrastructure budget, soft cost, the contingency fund, our calculations finally spits out a number. That is the residual land value. It's the absolute most that we could possibly pay for the land. Well, remember what that seller came in asking for: $1.2 million. Our model, based on all these realistic conservative numbers, tells us the maximum that we can pay for that land with that as our goal is just under 300,000. So let that sink in. The seller wants over $1 million. Our data-driven analysis says it's worth less than a quarter of that to us. Now, interestingly enough, it may be worth more as it sits. It's just not worth developing because of what needs to be done. Now, this isn't some magical real price, right? It's just the output of our model, and it's super sensitive to every assumption that we made. But it blows the lid off a huge gap between the seller's hopes and a developer's reality. The seller sees 45 acres and a big, juicy revenue number. They aren't pricing it in the seven-figure cost to build infrastructure. And the developer's required profit, the risk, the time, and the carrying cost to make it all happen. That's where we're coming in, right? And that's why our numbers are worlds apart. And it doesn't really make sense to go any further with this. So what's the big takeaway here? Well, the asking price is just a suggestion. It's the opening line of a conversation. The real price is found by meticulously working backwards from what the market will actually pay for the finished project. This underwriting process isn't about trying to lowball a seller. It's about replacing gut feelings and speculation with cold, hard data. It's what protects your capital and forces you to stare the real risks and costs of a deal in the face before you're financially committed. It's how you turn a wild gamble into a calculated investment. And what's interesting with this is when you can present all of this information to a seller, they often will understand it better and be willing to work with you. Rather than just saying your price is crazy, you explain to them, have you looked at doing these things yourself? This is what the cost is going to be. Many have zero interest in taking that on, and because of that, they will move forward and work with you. So again, this is the exact process that separates the pros from the amateurs. The method we walk through here today was used by a student who learned it from training. You also need a better understanding of what buyers want right now and how to handle these things. And that's exactly why we're putting together a live 5-week training. We're focusing on what is working right now, not what worked during the easiest parts of the market. The training includes live sessions, live question and answers, and help looking through your real situations that you're working on. So for investors that want more direct help, the link to schedule a call is in the description. Just a conversation with us, no pressure, and let's see if it would be a worthwhile fit for us to work together. But the biggest point is this in all of this: don't choose a strategy just because it sounds exciting. Look at deals like this require real analysis. If you're looking at land, the first thing you need to do is have a due diligence process, and that's what we've talked about here in this entire video. And that's why we created our free due diligence playbook. It helps you review access, utilities, zoning, flood zones, wetlands, title concerns, pricing, what the buyer demand is, and usability before you buy. Yes, this video was talking about putting in a potential development and subdivision, but these same things need to be examined on every single piece of property, even if you're buying it just to flip it, or even if you're not going to buy it. You're going to assign it or double close to make sure that there's actually an exit strategy. So again, this is free and the link is in the description. You can go get it. All you have to do is give your email and it'll be sent to you immediately. And now that we're done with all this, I want you to tell me something in the comments. I want you to let me know what you think about what we just talked about. Do you see why the numbers that I mentioned just did not make sense in this case? But looking at it, do you see the potential for something like this? Let me know your thoughts.